This is PJ Denuzo with Denuzo Wealth Management, and I would like to thank you for tuning in today to a DWM Denuzo Wealth Management Insight titled Pursuing a Better Investment Experience. And when pursuing the better investment experience, a lot of people look to investments first and foremost, but we in our team at Denuzo Wealth Management have always led with planning first. In the recent book that I just published, there are titled The 7 Keys to Investing Success. There are two most important chapters that I identify in the book, and I call it a tie for the #1 position. And that is the chapter that deals with having a plan, which is what we lead with first and foremost. And the second one is controlling your emotions, managing your emotions. And that's what we're going to be talking about today. This falls under the category our investment philosophy and investment process in control what you can control. The markets are very, very efficient. We're arguably the largest, oldest index efficient market theory manager in the city of Pittsburgh, Southwestern PA, tri-state area. And this has been for 31 years our belief that let's control what we can control. The markets are very efficient, and I'd like to take just a little bit deeper dive with you today. So thank you very much for tuning in. First and foremost, we want to embrace how powerful and how efficient the capital markets are. The capital markets are not exactly efficient every moment of every day, but they're so efficient consistently that no one on a regular basis or even a semi-regular basis has the ability to take advantage of any mispricings in the market on a consistent basis. So the first thing we want to do is embrace market pricing, which we refer to as price discovery. That all known information is incorporated into every security as well as possible, literally on a second-by-second basis, a minute-by-minute basis, and no one is going to be able to take unfair advantage to quote-unquote see something that millions and millions of other highly intelligent investors are unable to see. So regarding embracing market pricing, when we look at the market, taking all available information, the data we captured from last full year we have available, 2019, over $400 billion of trading value on a daily average in the capital markets. And people often forget that there is a buyer, but there's also a seller. There's two individuals looking at exactly the same security in every case, and one is willing or more than willing to let go of that security, and the other one is willing or more than willing to purchase that security. Two diametrically binary opposed perspectives, and that is what leads us to our price discovery, this constant repricing of every security in the market. We believe at Denuzo Wealth Management that the only reason a stock or bond or any security in the capital markets changes in value is because of new information incorporated into the market and into that security. Our second rule would be don't try to outguess the market. What I presented here for you is some research over the last 20 years regarding stock mutual funds, referred as equity funds, and fixed income mutual funds, which would be the bond mutual funds. And just to take a look at the beginning of the period, if we look at the equity at the stock mutual funds, we have 2,758 companies at the beginning of this period. And I just go right to the bottom number and looking at only 22% winners over that point in time. Almost equally startling is that only 41% of stock mutual funds survived that period of time out of the original 2,758. So again, the 22% in winners, the winners over extended period of times basically are never more than what we'd expect from a coin flip, just from flipping a coin. In fact, oftentimes it's surprising that there's less winners in the market than if you were just to flip a coin over time. We see the same type of statistics over and over again on the bond market. The bond market is very highly efficient as well. 1,843 bond mutual fund managers at the beginning of the period. Again, only 42% survived, and in this case, only 10% winners. And again, I always remind anyone I'm talking with that these are extraordinarily bright men and women and teams managing these stock and bond mutual funds. And when you think about it, it's because of the collective genius of them, along with all other market participants, looking at every security on a second-by-second basis that provides that highest level of price discovery that allows the market to be as powerful and as efficient as it is, and especially over longer periods of time. At Denuso Wealth Management, we constantly remind our clients that we're building a portfolio for you for the rest of your life. In typical situations, that is 30 plus years. Even if it's over a decade or over 20 years, typically a very long period of time, we want to put this power and these probabilities for success on our side. Again, what does the average individual do whenever they are actively participating in the market? They're not embracing efficient market theory. They're not embracing the power of indexing and indexing done properly and tilting towards the premiums that I'll discuss, would be chasing past performance. This is one of the most typical and common things that we see. If an individual is going to try to pick active managers, what will they typically do? They'll take a look at the performance for the last 1 or 3 or 5 year period of time. They'll pick the top performers, but picking those top performers, or as we refer to at Denuso Wealth Management, chasing that performance, how does that play out for you over a period of time? So here we're looking at a 10-year period of time. We're looking at the average of the average mutual fund 5 years following when it was in the top quartile. So the top 25%, the next 25%, the third and the fourth. So you're looking at the top 25% performers in mutual funds and how did they perform over the subsequent 5 year period of time. As you can see, if you solely pick the top 25% performers, only 21% were still in the top 25% 5 years later. So typically people are coming to the party late, leave the party early. You're coming to the party late whenever you are chasing performance and you're looking what's done the best over the recent 5 year period of time. And it typically ends somewhat abysmally as we're looking at here. The next most powerful theory that we have behind us in a successful client experience in controlling what we can control with Denuso Wealth Management is letting the markets work for you. Just the power of the capital markets, the premiums in the market makes sense. We like to say that the market is typically surprising over short or intermediate periods of time, but it's never surprising over longer periods of time, 10 years, but especially once you start getting to 10, 15, 20-year periods of time. What I'd like to illustrate with you here on the image that I've created is just taking a look, starting at the bottom, of inflation. Inflation is the silent cancer regarding capital assets eating in to my and your portfolio on a daily, weekly, monthly, annual basis. And oftentimes, folks want to go into something that they would call a safe investment. And a safe investment I would offer to you here would be the line that sort of, I always say it's almost just painted right on top of inflation, is U.S. Treasury bills. And the U.S. Treasury bills would be analogous here to whenever you think about CDs at the bank. Be very similar rates of return over time. And all those CDs or shorter term Treasury bills may seem like a safe investment. We've always referred to at Denuso Wealth Management, if you're invested 100% in those type of investments, you're losing money safely, and slowly, but nonetheless, you're losing money. And what we mean by that is you're going to be taking withdrawals out of your portfolio to live off of at some point in time. When you take those withdrawals out of your portfolio, if you're withdrawing 3 or 4, or hopefully not more than 5% typically maximum, but even if you're withdrawing 4% per year, if your investments are barely keeping pace with inflation, you can take a look that you're eating into the muscle and then ultimately the bone in that portfolio. To take a look at our long-term perspective, even looking at the lighter blue image on our chart for U.S. large cap stocks, $1 invested, of course, in U.S. Treasury bills in 1926 grew to $22, while $1 invested in U.S. large cap grew to $9,237. Again, you'll see right on the front, if you've ever looked at one of our investment plans or investment policy statements, 5-year plan. At Denuso Wealth Management, we've said from day one that we don't want any of our clients to ever be invested or exposed to the stock market for any period of time less than 5 years. If you start to let the power of the capital markets and this growth work for you, that is what's going to provide you with the long-term growth and success in your, we refer to it as your Denuso Financial Wellness Life Plan, by controlling what you can control. Additionally, on top, we see the power of small cap stocks. The market over extended period of times has tended for 100 years to sensibly reward risk. Small companies are riskier than large companies. They've grown faster over time. But as we've often said at Denuso Wealth Management, when large stocks catch a cold, small stocks often catch pneumonia. So you just want a small percentage, in our opinion, in a typical portfolio allocated to small stocks because of the long-term advantages of adding this to your recipe, into your formula, into your portfolio structure. And again, considering the drivers of returns, and I referred to earlier, quote unquote, premiums or tilting a portfolio, and the drivers of returns, when we look at equities listed on top, and again, equities is just a fancy word for stocks. And I would just mention one premium we're not showing here is what I refer to as the granddaddy of all premiums, would be stocks versus bonds, stocks versus CDs, et cetera. Just buying a broad basket of stocks versus bonds, there's a material expected premium in that investment of historically anywhere from 3% more over a period of time to maybe 7% more versus CDs over time. Diving a little bit deeper, the next time we see under equities would be company size. This would be referring to the premium I mentioned to you for small stocks versus large. So small stocks have outperformed large stocks over time. Again, over reasonable holding periods, we would expect that small stocks would have a very high probability of providing us with an extra rate of return in our overall portfolio. The next level we have listed is relative price, and price would be the value premium that we talk about, value stocks outperforming growth stocks over time. Again, we're looking at US markets, international markets, and emerging markets, that there has historically been what we refer to as a value premium, and that is why we like to add value to our clients' portfolios for the best structure, again, over a long period of times. The last premium is profitability. This has come into vogue and has come under the microscope of academia through empirical research over the course of the last decade or so. And we've incorporated this into our portfolio starting a few years ago to oversimplify. If you can identify with empirical rigor more highly profitable companies, they tend to provide higher rates of return in the future than lower profitable companies. The two I'll mention real quick on fixed income are term and credit. The supermajority of bond premiums are in these two areas. Term would be the term of the bond, 10-year bonds versus 2-year bonds. 10-year bonds on average are paying a higher rate of interest because it's a longer term than a 2-year bond. And credit, single A rated companies are going to tend to pay a higher rate of interest because they're deemed by the market to be more risky than a triple A company, and that is what we refer to as the credit risk. Again, for our clients, we're doing a deeper dive in this presentation, but these are the things that we worry about for our clients that we don't want them to have to worry about. We're looking at these topics that I'm discussing today on a daily basis, weekly, monthly, quarterly. We have different systems, but just to let you know, getting down to the footer and foundation, how we build our portfolios and how we want to control what we can control. Our next topic is what we refer to as smart diversification. Here I'm just using a real basic image of what I call a home market portfolio, home market index portfolio. I'm showing the S&P 500, of course, invested in one country and 500 stocks versus a global market index portfolio. So the MSCI ACWI, the ACWI, again, 49 countries, 9,031 stocks as of recently when I put this presentation together. And again, we're just discussing smart diversification. We don't want to have all of our eggs in one basket. We do have the majority to supermajority of our equities in the US market at Denuso Wealth Management, but we want to enjoy, especially over long periods of time. Again, we're building a portfolio for our clients, as we tell them, for the rest of their life. If we're building a portfolio for you for the rest of your life to control what we can, give you the best probabilities of making the most with the least amount of risk, and most importantly, helping you live your best life through your Denuso Financial Wellness Life Plan, we want true smart diversification in your portfolio. The next one, as you've heard before, is avoid market timing. You can take a look at any block on this image over an extended period of time and just follow that color, whether it's blue or gray or sky blue, from year to year. And this is in the folly, again, of active management and market timing, trying to follow and foresee which we would refer to asset class, whether it's US large stocks or international small stocks, which asset class is going to do better over a future period of time. Again, all known information is priced into every security on a second by second, minute by minute, hour by hour, day by day basis by the collective genius of millions of investors. And trying to outsmart them in plain English, we refer to it as at Denuso Wealth Management as a quote unquote loser's game. I had discussed earlier the power of managing your emotions. This, again, as I said, in our opinion at Denuso Wealth Management, is in a tie for the number one variable that you must succeed at to be a successful long-term investor and have your plan succeed. The first one, again, is to have a plan, and the second is to manage your emotions. I just have a simple image here. Many of you have seen our Denuso Wealth Management roller coaster, which has a few more identifications along the roller coaster. But this one makes the basic point that at some point in time, individual investors are in the market and they're optimistic. The market goes up and they're elated. It goes down, they're nervous. And then it goes down some more and there's fear in the marketplace. Somewhere between nervousness and fear is typically when individuals will capitulate, as in selling some or most or all of their stock positions. The average individual investor has been proven through empirical research time and time again over decades and decades to be wrong about 2 out of 3 times when they make what we would refer to as a market call. When they decide that they're too conservatively invested and they want to take some of the money out of bonds or out of cash and add that to stocks, or vice versa, when they think that the market is going to underperform in some point in time during the future, so they're going to take a chunk of stocks and convert that over to cash or bonds. Again, anything in life, if you know that over decades and decades that hundreds of thousands, millions of investors are wrong about any topic 2 out of 3 times, you need to have extreme caution before you would venture into making a future guesstimate regarding that topic. The 9th topic I had is looking beyond the headlines, and this is basically an adjunct to controlling your emotions. The financial media and the media in general is, and truthfully, your enemy when it comes to long-term success. They know that there's 2 magnets on the wall from the room you're sitting in. On the far wall is one that says greed. On the other wall, on the other end of the room, is one that says fear. Basically, every article, every social media post, anything online, on TV that you see is basically written towards one of those massive human emotions of fear or greed. If you're bringing fear or greed into any of your personal financial decisions, you're certainly on a road to a less than optimal outcome, I'll place it. So you can take a look at looking beyond the headlines. You know, the daily news can just eat you up. A lot of times we're talking to clients, we'll ask them, are you watching the stock channel, whatever it may be? Just take a look at the titles: retire rich, sell stocks now, the looming recession, etc. Again, we want you to focus on living your best life, controlling what you can control, and having a long-term plan based on the best empirical research and the highest probabilities for success possible. And last, number 10, which I had mentioned earlier throughout today's presentation, focus on what you can control. So we said at Denuso Wealth Management for decades and decades, control what you can control. I've told folks over and over, I've seen a lot of individuals come to us, prospective clients, looked at their cases, and a lot of people in challenging situations. I've never seen anyone truthfully who controlled what they could control reasonably in their plan who hasn't succeeded. So again, you control what you can control, you make the trade-offs that are necessary, and you can live your best life. What we're referring to, again, on focusing on what you can control, again, create an investment plan to fit your needs and risk tolerance. We're talking about an Uber investment plan. The investments folded in as an addendum, so to speak, to your Denuso Financial Wellness Life Plan. Again, the investments are important, but they're not the driving force in your long-term success. Your overall plan and the other dozens and dozens of challenges and levers and switches that we manage are of equal or greater importance, along with the investments for your long-term success. Structure your portfolio along the dimensions of expected returns. We referred to, again, I mentioned the premiums in the market. There is stocks versus bonds, value versus growth, small versus large, profitable, higher profitability versus lower profitability. and then term and credit on the bond side. We want to diversify globally, again, trying to time which broad asset class is going to do better on an annual basis, domestic in the US, international developed markets, emerging markets. There's a rotation that you see over time. Sometimes the rotation is 2 or 3 years. Sometimes it's 5 or 7 years, but there's just no way of timing that. You need to build a broadly diversified portfolio to set your highest expected rate of return, also in tandem with your lowest expected risk. The typical individual we talk to when they first come to us, if they're a prospective client, they're looking solely at the return side of a portfolio. They don't have any concept or anything built to manage the downside of their portfolio for how volatile it's going to be or manage risks. They're looking solely at a single variable of return. Every single investment we're looking at in our clients' portfolios, we have a dual goal, and that is what is the expected rate of return and what is the expected risk at the individual position level as well as the aggregate portfolio. Again, we want to control what we can control and manage expenses, manage turnover, manage taxes. Again, efficient market theory and indexing has served us very well on that topic. And finally, to stay disciplined through market dips and swings. Again, that comes under managing your emotions, which I've discussed a number of times throughout today's presentation. Again, this is PJ Denuzzo with Denuzzo Wealth Management, and I really want to thank you for tuning in today for a key element of our Denuzzo Financial Wellness Life Plan and our overall client experience regarding having the best investment experience possible. And again, I want to thank you very much for tuning in today and look forward to seeing you again.